Hey guys, what's up? I hope that your preparations for the upcoming RBI Grade B exam are going really well. So, welcome to today's lecture series for ESI, that is Economics and Social Issues for the RBI Grade B Phase 2 exam. And today we're going to discuss the topic of BOP, that is Balance of Payments. It's a very important topic, guys. I mean, it's one of the very basic things of ESI, and it's very important to understand the overall basic concepts of how payments between nations go in terms of their current accounts and their capital accounts. And then it's also very important to understand how the origin of globalization, privatization and liberalization came into being in India in the year of 1991. And then there's a lot of other concepts as well which are interlinked to it. For example, the CAD and a few other concepts as well. So it's a very important chapter for the RBI Grade B Phase 2 exam. It's not like your basic chapters like poverty and unemployment and health. It's much more important. It's I mean, at par with the monetary and the fiscal policy, I would say. So please study it accordingly. It's very important. And again, not just for RBI Grade B, but also for SEBI Grade A and NABARD Grade A. It's equally important because the syllabi are exactly the same for ESI syllabus. So it's a very important chapter. Go through it accordingly. Be very attentive. And of course, as soon as you finish with this, try to make notes out of this video and then go through the PDF notes that we've provided you along with this lecture. Okay. So please be very attentive, guys. It's going to be a very important chapter, and if you haven't heard about BOP before, then trust me, it's going to be very interesting. Okay, guys. So then, on that note, let's begin with the topic of balance of payments. Now, in this chapter, we're going to the topics that we're going to cover over here are, first of all, we'll do BOP and its basic components, and then beyond that we'll try to actually understand all of those components which come in the form of current account, capital account, forex reserves and errors and omissions. And during that process we'll cover a few more topics like the currency exchange rate systems which are prevalent across the global economies. And then we'll do the rupee convertibility, or how our currency is convertible in terms of getting other currencies in place of rupee, for example dollar, or let's say pound or euro. And then finally we'll come on to the BOP crisis of 1991, and in general what a BOP crisis is and how it affects the economy and why it occurs. Okay, all of that we'll discuss in this chapter. So that's all about the contents. And now let's move on to the first slide then. So the first slide over here is BOP. What BOP is, what is the basic concept of BOP, what it stands for. So first of all, as you all know, BOP, the full form of BOP is balance of payments, right? Balance of payments. So what do these balance of payments stand for? This balance of payments is actually a systematically recorded economic transactions of a country with the rest of the world for a given period of time. Okay, that can be for a financial year, which is in general, this is how we record our financial instruments, or in general, or the economic transactions of a country. But it can also be recorded for, let's say, H1 or H2, that is one half of a year, or Q1 or Q2, Q3 or Q4, which is a quarter of a year, a financial year. Or it can even be calculated for a single month, let's say the month of October or the month of Jan. It can be done for any, like there's no limit to which time period you can use for it. It can be done for any kind of period of time. Okay, but it basically is a systemic record of economic transactions of a country with the rest of the world. Okay, basically all those entities which fall outside the country, these transactions come under BOP. Fine. So once we're done with this concept, then we move on to the fact that it includes all transactions between the residents of a country and the rest of the world, right? Because who would be doing these transactions? It would be the residents of the country Exactly right. So it includes all the transactions between the residents of the country and the rest of the world. But who else apart from the residents can also do these transactions? Organizations, right? So by organizations, I mean firms, companies, and then not just the corporates, but also the share market. They can be, because even if you're not directly getting associated with a company, you can associate yourself with the share market. For example, the Sensex or the Nifty, whatever is there in India. I mean, wherever you want to invest in India, as in, and then you can invest with the government, right? So there can be government transactions. So there's a number of entities that come into play over here, but the major thing is the residence, of course, because that is the core of any country. Then the BOP of India will record transactions which happen between the Indian citizens or the Indian residents, including the individuals, the companies, and the government, as we talked about, the three pillars, the three main pillars, and the non-resident foreign citizens and other foreign entities. And again, the foreign entities, apart from the citizens, would include their companies and their governments. So over here we have the residents, and then we have our local companies or the national companies, the companies which belong to the nation, and then we have the government. Okay, and on the other side we have foreign individuals or foreigners, and then we have their foreign companies, and then we have the foreign governments. Okay, so when we take all of these entities into account, let's say this is the group A and this is the group B, right? Group A is the local residents or the residents of the country, the local companies, and the local government. And the group B is the foreign residents, the foreign companies, and the foreign government. Now, if you do any kind of a cross transaction between these, where the transaction goes between one entity in the group A and another entity in the group B, let's say that can be this, or that can be this, or that can be this, or that can even be this, any kind of a cross transaction between the group A and group B, that transaction will fall under the ambit of BOP or balance of payments. Got it? It's that simple, guys. And then finally, the last point over here is that the record of BOP is prepared by the RBI or the Reserve Bank of India, and it is measured in USD or US dollars. Okay, so the Reserve Bank of India is the entity that records the BOP of India, and this record is maintained in the form of USDs or US dollars. Okay, that is how they have standardized it. And of course, the RBI, when it prepares the BOP statement of India, it is actually done on the basis of the principles which were created by the IMF or the International Monetary Fund. Got it? So IMF gave the principles, and on the basis of those principles, RBI makes the BOP statement, and this is done in the form of US dollars. Got it? So let's move ahead then. Now the components of BOP. So BOP basically consists of four basic components, which when accounted for together, they form the BOP of the nation. Okay, so the first component over here is the current account. Then the second is capital account. Third is the changes in the forex reserves. And the fourth one is the errors and omissions. Got it? Actually, what we try to calculate in the BOP is, because it is a balance, right? It is a balance of payments. So when we're trying to calculate any kind of a balance, what we actually do is we measure the delta or the change in each kind of account. So when we consider the current account, we actually consider the changes that are happening in the current account. That is, for example, if if let's say we consider our imports to be negative and our exports to be, let me put it over here, imports to be negative and exports to be positive, then let's assume that we had exports worth 100 crores and then an import of worth, let's say, 80 crores. Then when we take exports to be positive and imports to be negative, and when we finally add them up, what we get is a balance of payment of 20 crores, right? So this is the change in our current account. Now, what exactly current account is, that is something that we're going to discuss in the next slide, so don't worry about that. For now, what I'm telling you is that what we are trying to calculate over here is not the net current account, as in adding all the imports and exports. That won't give you anything. That would just be a sheer wastage of time. But if you take them with the correct signs along with them, right, if it is positive or negative, and then when you add them up and see the changes in the accounts, with that, whether that be the current account or the capital account or the forex reserves or the errors and omissions, when you take all of them with the right sign and you finally end up with the changes in each account, and you add up all of those changes, okay, so you add these up, that is when you finally get the BOP. Okay, so for BOP you have to add all of these accounts up, all of these four parts of the BOP, you have to add them up, and that too only the changes in them. Okay, the changes in each part, each component have to be added up. Got it, guys? So these are the components of BOP. Make a note. Now let's move ahead. The first component we're going to discuss over here, that is the current account. So what is current account? Current account is basically an account that deals in those transactions which do not create any future obligations or liabilities. Okay, so any kind of a transaction where a obligation or a liability, or even for that matter an asset, is not being created, is a part of the current account. So I'll write it over here. No asset slash liability. And I believe that I've discussed this topic of assets and liabilities in a very detailed manner in another chapter. And if you want to refer to it, I will still give you a very crude idea of what an asset is and what a liability is. Okay, guys. So, but I hope that you know the basics of assets and liabilities, because these are such basic terms that if I start going into all of these basic terms, then I'll also have to start going into terms like account, that what an account is, right? Because at the end of the day, every term has some meaning, and it's next to impossible for a person to give you all of those meanings. So I hope that if there are things that you do not understand, you will also be putting in your own effort along with that, so that everything, because everything can't be spoon fed to you guys, right? But still, for asset and liability, I will give you the meanings, because some people do end up having a problem with them. So what is an asset? An asset is any kind of property or any kind of thing that can be owned by a person or an organization. Okay, so asset is basically a materialistic thing or property slash property that can be seen or owned. Okay, seen and owned. You can also say seen and owned, or owned, whatever you want to say over here. So basically, for example, let's talk about money, cash. Cash is an asset. It's a materialistic thing or a property, and it can be seen and owned by a person. Okay, and if you don't even want to use the word seen, owned is sufficient to justify this definition of asset. For example, we talk about, let's say, another thing, gold. Gold is again a materialistic thing or a property which can be owned by a person or an organization, right? Then we talk about, let's say, land. Land is again a materialistic thing that can be owned or uh, owned by a person or an organization. Same goes for infrastructure and so on. So all these come under assets. And what is a liability now? The liability is basically an opposite of a an asset. It basically is a state where a person or an organization is legally responsible. The keyword being legally over here, legally responsible to give, or you know to give something to someone else. Okay, so give or pay something to someone else. Legally responsible to give or pay back. For example, let's assume that a person goes and takes a loan. Now, when you take a loan is basically a contract that you will pay back X amount of money with Y amount of interest by a Z period of time, by the end of a Z period of time, right? So, what is that? That is a legally binding agreement. So, that a loan is a liability. Similarly, bonds are also liabilities, right? Because bonds again ensure that the person who's issued the bond is legally responsible to pay back the bond holder by the end of the tenure of the bond, right? So, and there can be other kinds of liabilities as well. Basically, wherever you are legally responsible to give or pay back, that becomes a kind of a liability. It's a legal state of being responsible for something. Okay, and that, I mean, it's not just uh, money. It can be any other thing as well, where you are legally responsible for something. That also falls under liabilities, but for economics, it is generally something which holds economic or monetary value. All right. Otherwise, liability is a very, very broad term, but we don't want to get into that today. So, any place where an asset or a liability is getting created or destroyed, that kind of a transaction falls under current capital accounts. Okay. And anything where the assets or liabilities are not being touched. Anything where the assets or liabilities are not being touched, so no asset or liability, that kind of a transaction falls under current account. Got it, guys? So that is the two separate kinds of accounts which we divide our uh, entire payments into. The first one is current account and the second one is capital account. The capital account is where uh, asset or liability is being created or destroyed, asset or liability, and current account is basically where no asset or liability is being created or destroyed. Okay. And apart from that, the only two things that do not fall under these categories are the forex reserves, that is the foreign exchange reserves, because they are reserves. They are not payments between two countries. They are actually reserves which are being saved. They're like savings. Okay, so reserves are very different. That is why they do not fall under either kind of category of payment, neither the current nor the capital. And errors and omissions, again, as the name suggests, they are errors. So errors can't fall under the account payments because they were actually not considered in those payments. That is why they became errors, right? So basic division between payments can always be made in the form of number one current and number two capital accounts. So current account is an account where no asset or liability is being created or destroyed, and the capital account is basically where assets or liabilities are being created or destroyed with the payments being made. Okay, guys. So let's move ahead then. I think that's more than enough for assets and liabilities for today. So moving ahead, the current account comprises of visible trade, that is goods, and invisible trade, that is services. Now here again we come across two concepts. The first is of visibles and the second is of invisibles. Okay. And then there's a third concept of transfer payments as well. And fourth one, investments. This everyone knows. Okay. So the current account basically, it has four major components which fall under it. The first one is visible trade, which is goods, and the second one is invisible trade, which is services, and the third one is transfer payments, and fourth is investments. Now, I assume that everyone knows the meaning of investments, so I won't tell you the meaning of that. I won't waste my time in that, and yours as well. So, everyone knows what investments are. Now, let's move on to visible and invisible trade first. So, what is a visible trade? Visible trade is any kind of a trade where you make a payment. So, there are two people over here, person 1 and person 2. The person 1 makes a payment to person 2, and the person 2 in turn gives a good or a service to the person 1. Okay, because that is how any kind of a transaction, physical transaction takes place. One person gives payment or money, and the other person in return gives them a good or a service, right? So what happens over here is that if the other person is giving you a good, then it can actually be physically seen, right? There is a proper physical transaction, a movement of goods, especially if it is between countries. Then there is a proper physical movement of goods, and at each specific point it is very easy to track those, that where did it come from and where did it go, right? So these are totally visible trades, because the product that is being traded over here can easily be seen, and it does not get hidden in the economy easily, right? But what happens in the second case, where we have an invisible trade, is that for the payment which was made, now instead of a good, a service was given. Okay, so this person now paid back with a service. What happens for services is that let's assume any service. For example, let's assume a taxi service. For example, you go for rides like Uber or Ola, whatever you wish for, and what happens is that you pay them money, and in return the cab operator gives you a taxi ride from, let's say, okay, let's make a nice taxi over here, the best that I can make. I mean, I know this is not the best, of course, but the best that I can make with this platform right now. So let's assume that this cab operator company gives you a taxi ride from, let's say, this point to this point. Okay, so you reach here, but was there a physical asset that was created with this service? The answer is no, right? There is no good that came from this person to you or this operator to you. And the if the government wants to see if you took something in the form of a transaction, it won't be easy for them, right? It won't be easy in terms of the fact that they can't keep tracking every ride you make, and this is still a very very formal kind of a sector. If you move to a more informal kind of a sector, let's assume that over here there is an auto rickshaw. I mean, I don't know how to make an auto rickshaw, but let's assume this is an auto rickshaw with, of course, three wheels. Okay, so let's assume this is an auto rickshaw. Now, an auto rickshaw is a much more grayer part of the economy, in the fact that it can't even be tracked how much income that auto rickshaw driver is making, right? Because there is no receipt for it, there is no interest, I mean, not interest, but there is no tax that is being paid for his income, and no one knows how many rides he took that day, right? Or rather than took, how many rides he gave that day. So it is a very very gray area of the economy, and it becomes very difficult to regulate such sectors in the economy and know that how many rides this autowala gave, and where from what point A to what point B did he or she drop you. Because this kind of a service is, number one, not tracked, number two, not recorded, and number three, it is not even a physical asset which can be easily tracked, right? Easily measured. So if it can't be easily measured, then this falls under the invisible part of the trade, and that is where all the services fall as well, because in services there is no physical good that can be tracked. So that is why all the services are actually known as invisible trade, because they are very difficult to track, and they generally tend to get lost in the economy, in the sense that they generally do not uh, get directly calculated or counted in the BOP very easily. So it is very easy to skip these in the calculation of our BOP, and this is very difficult to skip, because this at the end of the day does somehow or the other, it does come into the kitty of the government in the form of, a transaction that can be tracked and traced. But services are something that are very difficult to track, and they generally form the invisible component of a trade. Okay, so I hope you understood why goods are a visible component and services are an invisible component. Right, guys? So these are the first two types, and then the third type was transfer payments. Now, what is a transfer payment? Let me just erase this. So a transfer payment is basically, let's assume that there is someone in your household who is living in the US and working over there, but that person, let's say your brother or your sister, is not actually not actually settled over there with his or her entire family. Okay, so the family stays in India, but that person uh, alone is living in the US and working over there, and working really hard to earn money in dollars so that he or she can send it back to their family in India, which can then get converted into rupees, and they can, of course, have a decent kind of a life, right? So what happens in this kind of a system is that when this person will send back money to his or her home, will this person actually ask for a good or a service in return, as was happening in normal kinds of payment systems? The answer is no, right? There, when this payment is made by this person to the other person, there is no good or service that is being given in return. uh, a family is not something where you get goods or services in return for every payment that you make. If that was the case, then no child would actually even get proper education in India, right? And not just India, but the entire globe, of course. So family is not family is not a place where things work in the strict economic sense. And then there is many other things as well, where not just family, but even friends send money to each other in the forms of gifts, right? In the form of gifts, and then in the form of other, let's say, uh, what else can be there? There can be, let's say, any other kind of payment that you want to send back home, or let's say a subsidy or something. Okay, subsidy is also a kind of a transfer payment, because there is nothing in return that is being given for it. And then there is, let's say, any kind of a financial aid that is being given by the government. Again, for that also, the individual who gets the aid is not giving anything back. And then there can be a number of things. So all of these, where the payment made or the income received, where no good or service is being paid for in return, such a benefit or a payment is known as a transfer payment. And the transfer payments can sometimes also be called by the name of subsidy. Okay, subsidy is also an alternate word that can be used instead of transfer payments. But basically, a transfer payment is any payment where no good or a service is being given in return for that payment. Okay, guys? So all of these four things, the visible trade, the invisible trade, the transfer payments, and the investments, all of them fall under the category of current account payments. Okay, these are all payments under the current account. And now finally, one more thing that I wanted to tell you, that is that the investments which come in the form of income earned by the factors of production, these can actually be in a number of forms. For example, all kinds of incomes that are earned by factors of production, like profits earned for the entrepreneurship, and then dividends that are earned for, again, people who invest in the shares, and then interest payments for capital, then wages for all kinds of workers or labor, and then rent for all kinds of land. All of these incomes also come under the investment category only. Okay, so investment or income, you can say, all of these fall under the current account only. Okay, so these are the components of current account. These were a bit tricky, so I had to take a lot of time with them. And now let's move ahead then. So the current account is sometimes also called a saving investment account, or the export import account, or the credit debit account of a nation. Okay, guys. Then the visibles, they include goods and merchandise, as we talked about above, so we do not need to talk about this now again. And the invisibles, they include the services, the factors of incomes, and the transfer payments as well. So the transfer payments are also something that you can directly include in the invisibles, because again, for transfer payments, there is no direct good or service that is getting associated with it. See, invisibles are basically not anything where goods are not directly associated. Services can or cannot be associated with them, but for transfer payments, neither a good nor a service is being associated, so they definitely are a sub component of invisibles. So if we talk about invisibles, this if this circle is invisibles, where half of it is being let's say counted under those which fall in only services category, and these are neither goods nor services category, then this entire area would actually be a part of the transfer rate. So this is where transfer payments lies. It is actually a sub component or a sub part of invisibles trades. Got it, guys? And then factor incomes again are something where no good is directly associated, right? Because if you're getting a factor income, it's most probably for a service, like let's say labor, or let's say land which you gave, or let's say the entrepreneurship, or any kind of an investment. All of these, for the factor incomes, again fall under the category of services mostly, and services are a part of the invisible trade. Okay, so the income from factors, or the factor incomes, can also be calculated in invisibles only, and the transfer payments also can be put under them. So the visibles and the invisibles trade are basically the two very very broad components which fall under the current account of a nation. Okay, so if anyone says that visibles and invisibles are the two only components of the current account, you can actually say that that is correct, because the rest of the components, the transfer payments and the investments and the income that we talked about, all of those are actually something that can be considered to be a sub component of this invisibles trade. Okay, guys. So let's move ahead then. Some additional terms. Now, the first term over here is trade deficit. So, what is a trade deficit? A deficit, as the word tells you, is something where we are falling short of. And what are we falling short of? At any given point of time, when we're talking about the economy of a nation, always remember that exports is a good thing and imports is a bad thing. As in, imports is not something which is bad in the sense that we should avoid it. No country can avoid its imports. It's also a very very crucial part of the economy, but in the very very strict economic sense, exports is something which brings money into the country. Okay, so the money increases, and imports is something for which we have to pay money to some other country, so our money decreases, right? So we are earning over here and we are spending over here. That is why exports is something which is always a positive thing for the economy, and imports is something which we consider to be kind of a negative thing. And that is exactly how we will now treat them for any kind of an economic analysis, or any kind of an economic calculation that we are doing. So if we consider them in that sense, then whenever a trade is happening, it is either an import or an export trade, right? So if the import is greater, then the negative component is higher, and the export is smaller or lesser, then the positive component is lower, right? And if the negative component is higher, then the overall transactions would fall negative if we subtract them, right? And in that sense, if it is overall negative, then what are we having? We are having a deficit is falling short, right? So our trade is having a deficit because the imports are greater than the exports. So that is what trade deficit means. And similarly, surplus is something where you have excess or more of something. And what will you have more of? The positive thing, that is the exports, right? So now in the trade surplus, the exports will always be greater than the imports, as simple as that. So when exports minus imports is positive, we have surplus, and when exports minus imports is negative, we have a deficit in our trade. Okay guys, and an interesting part over here is that these deficits and surplus, they do not apply to the capital account. The trade deficit and the trade surplus, they only apply to the current account of a country. Capital account is something where we do not directly talk about the trade deficit or trade surplus. Okay guys, so let's move to the next term then. Current account deficit, or CAD, or CAD as we call it. Now this is a very very important term guys, extremely crucial. You should know the meaning of this term. The current account deficit is basically, I mean, it sounds like a big term, but it's nothing. It's mazak ho raha hai basically. It's kind of a joke. So what CAD is? CAD is basically nothing but the measure of deficit in the current account, right? Deficit in the current account. That is what the term itself says, that is the meaning of CAD. So basically when we take both the visibles and the invisibles together, that becomes the overall current account, right? And in this overall current account, whatever the export minus import is, or rather the import minus export, I would say, because it is already a deficit, which means we are trying to calculate the negative component of it. Then the imports might give you the current account deficit, or the CAD of a country. Okay, so that is the CAD. Next comes BOT. Now BOT is, again, see, it sounds like BOP, right? BOP is balance of payments, and then BOT is balance of trade. It sounds like it's very similar to BOP, but it is not. Trust me guys, it is not. It is very different. If BOP is this, if this circle is BOP, this small circle is BOT. Okay, BOT is this small circle, and this is BOP. So it's a very very small sub component of balance of payments. And what sub component are we talking about in this BOT or balance of trade? It is only the balance between the imports and the exports in the visibles. Okay, so BOP has sub components like current account, capital account, and then it has the forex reserve changes, and then it has the errors and omissions. All of these are a part of the BOP, but for BOT we only consider the current account, and that too not as a whole, but only or merely the visible part of the current account is considered. Okay, only the visible part. So for current account deficit or CAD, we consider the entire current account, and for balance of trade, we consider only the balance between the visibles, or exports minus imports of the visibles of the current account. Okay, so this is a very very narrow term, and you have to remember this as well, the BOT. Got it guys? So let's move ahead then. Now we're done with the current account component of our chapter, and we can now move towards the capital account. So what is the capital account? Capital account, as I already have told you, is basically a record of the inflow and outflow of capital directly, capital in the country that directly affects the country's external or foreign assets and liabilities. Okay, so there is a creation or destruction of assets and liabilities. That is where the capital account comes into play. So first of all, because these are international transactions, so only external or foreign will come into play. That is any kind of an asset or liability which is directly related to the relationship between the flow of money between our nation, that is India, and any other foreign nation. So if there is any kind of a flow of money between India and a foreign nation, so over here let's put money. So if money is flowing between from India to a foreign nation or from a foreign nation to India, either ways, and then this flow of money is creating a change or a delta in the assets or liabilities, then that kind of a transaction or any kind of economic transaction in that sense is actually a part of the capital account. Got it, guys? So that is a basic definition of a capital account. And now let's see the types of transactions that fall under the capital accounts of a nation. Okay, so the first one over here would be foreign investments. This is the most important part. I guess the majority of the capital account transactions actually fall under the foreign investments only, and it is a very very huge component. It consists of FDI and FPI. Okay, and this in itself is a big topic, so let's first delve into this. So what is FDI? FDI stands for foreign direct investments. Okay, so any kind of an investment in from a foreign country into our country, where that foreign, be it an individual or be it an organization or be it the government of any other country, it can be anything. So if that foreign entity is investing money in our country in the form of an investment in a company or a firm, a specific company or a firm, then that becomes FDI. Okay, and FPI stands for foreign portfolio investment, which comes through foreign institutional investors, FIIs. Okay, that is FIIs basically is any kind of a foreign institution, be that an individual or an organization or a company or whatever, which is coming into the capital market of a country, that is the share market, or trying to buy bonds or shares in a country, then that individual or organization is actually classified as FII or a foreign institutional investor, and an FII always brings FPI, that is foreign portfolio investment. Okay, so these are the two basic components of the foreign investments, and if you want to very crudely differentiate between them, then the Mayaram committee had given very 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 nice and simple recommendations for how you can differentiate between FDI and FPI, and you can always remember those because they are important and they can be asked in the exam as well, that which committee gave these recommendations or what are the recommendations that were given by the Mayaram committee or whatever. So you should first of all remember that the Mayaram committee is the one which was responsible to give the basic difference between FDI, that is foreign direct investment, and FPI, that is foreign portfolio investment. And what was that criteria? That criteria was greater than equal to 10%. So basically, if an entity is investing greater than equal to 10% in a company or a firm, okay, so if the investment is greater than equal to 10% in a firm, then that investment gets counted under FDI. Okay, FDI. Greater than equal to 10% is FDI, and anything below 10% or less than 10% falls under FPI or foreign portfolio investment. Okay, guys. So that is the crude differentiating factor between the FDI and the FPI. Now, uh, let's kind of delve into the other transactions that fall under the capital account as well. The second one over here is the external assistance. So any kind of an external assistance being given by any other nation, for example, let's say the US or China or some other nation, whatever. I know China would. I mean, China is not even in the race of giving external assistance to India. So that's again a very different thing. But let's assume that the USA, or let's assume the EU, European Union, or Japan, for example. Japan gives us a lot of external assistances. So let's assume that a country gives us some external assistance, or even for that matter, we also give external assistance to countries. For example, if we give it to Maldives or Sri Lanka, then that external assistance would fall under the transactions for capital account. Got it, guys? Then the third one over here is, and again, not just sovereign. See, what the transactions that I talked about right now were sovereign transactions between governments, where the government gets involved. There is another kind of external assistance transactions which can also take place, which are commercial, also known as in a very popular form, they are known as ECBs, or external commercial borrowings. Okay, external commercial borrowings. These also fall under external assistance. These are basically the commercial component of external assistance. For example, let's say a bank or an organization gives you any kind of external assistance that does not fall under sovereign, but it falls under, for example, let's say that a company in India was very badly in debt, and then it went to, let's say, a bank of the US, be it JP Morgan Chase or any other bank, and that bank gives it some assistance. So that assistance will fall under external commercial borrowings, because it is a borrowing that they got from an external company or an external group, and that will also fall under this external assistance category. Okay, so ECBs and sovereign external assistances both fall under, commercial and sovereign both fall under the category of capital accounts. Got it? Then the next one over here is commercial borrowings. So commercial borrowings is something where bank basically bank capital or banking capital comes into being. So for example, you take direct loans, they fall under the category of commercial borrowings. So any kind of a loan or any kind of a banking capital that is coming into play between transactions in between nations, that also falls in the capital account. And finally, NRI deposits. So NRIs are non-resident Indians. So Indians who are the citizens of India, the people who are the citizens of India but are not residing in India for more than 6 months in a year, more than 182 days in a year. If a person is residing in India for less than 182 days in a year but is still a resident of India, that person is called NRI, that is the non-resident Indian. Okay, so such basically a citizen, not a resident, but a citizen of India, but not residing in India. Got it? So if these NRIs come and deposit money in India, then that is also kind of a international transaction taking place, right? So that kind of a transaction falls under the NRI deposits category, which is a part of the capital account of a country. Got it, guys? Okay, then. So these are the basic kinds of transactions which fall under the capital account. So let's move ahead then. Now come the forex reserves. What are the forex reserves of a country? They basically are the forex stands for, first of all, foreign exchange. Okay, foreign exchange. Okay, so what is foreign exchange? Foreign exchange is basically all the reserves that a country has, or more specifically, these are generally they are maintained by the central bank of a nation. So more specifically, the reserves in the foreign currency, and not just the foreign currency, but all of these four kinds of reserves which a country's central bank, for example the RBI for India, has, these are actually categorized as the forex reserves of a country. Okay, or the foreign exchange reserves of a country. And what exactly is the components of this foreign exchange? The first is any foreign currency that the bank is holding or the RBI is holding. The second, that all the gold that it holds. Third one over here is STRs, or special drawing rights. Now these special drawing rights are basically they're not actually a currency, they're actually rights which you get as a by virtue of becoming a member of the IMF. You buy these STRs, you have to buy these STRs, and these STRs are actually a basket of currencies. Okay, so they're not a currency, but they're a basket of currencies. And if they're a basket of currencies, then they will actually be hedged against all the major currencies, including dollars, and then pounds and euros, and then Chinese yuan, and then yen, and all of the major currencies, they will be actually hedged against them because they are just a basket of these currencies, right? So they're also very very safe kind of a position for in terms of forex reserves. And then come the reserve tranche position in the IMF. Okay, so all of these four are the components of the forex reserves or the foreign exchange reserves of a country, which are held by its central bank. Alright guys, then moving ahead, the forex reserves are maintained by the central bank of the country, or the RBI in India's case, which I already told you in the beginning. And then the forex reserves can be increased by a current BOP surplus. This is a very important thing over here. Why? Because see, what happens is that when your current BOP is going in surplus, this means that the exports are greater than imports, right? The exports are higher than imports. And what does that mean? That means that you are overall getting more exports, means more income, and your the outgoing money or your expenditure is low as compared to the income, which means you are saving more money, as in you're getting more dollars and you are giving lesser rupees for that because you are exporting more. So when you start getting more dollars, those higher dollars start getting deposited into the forex reserves of the country, and those forex reserves start building up or piling up, right? And when they start increasing, that is actually the major cause for it is the current BOP surplus. And if the forex reserves start dwindling or start falling badly, then the reason for that is a current BOP deficit, or the imports are much higher as compared to the exports. Okay guys, so this is the forex reserves of a country. Next, moving ahead, we see the currency exchange rate systems in the global economy. So there are three basic types of currency exchange rate systems. Basically, first of all, what a currency exchange rate is. Currency exchange rate means that when, let's suppose you have rupees and then you want to sell them and convert them into dollars, right? So this exchanging between currencies, that is selling one currency and buying another for it, at what rate you do it. For example, let's assume that you're doing it around 72 rupees per dollar right now. So that rate at which you exchange between two currencies, that rate is known as the exchange rate of a currency. Okay, exchange rate, or rate at which you exchange between two currencies. So how come we have to pay 72 rupees per dollar? Why don't we just have to pay 50, or why don't we have to pay only 25 rupees per dollar? That is because this is the exchange rate of our currency, and it is determined by the currency exchange rate system of our nation. Okay, so there are three basic types of currency exchange rate systems in the global economy. The first out of them is fixed currency exchange rate system. Fixed means that the rate is actually fixed by or set by the central bank of a nation, and it is maintained by the central bank at that particular level. And what is the level which is set? The level is actually pegged or uh, brought kept fixed actually, as compared to either some other currency which is more stable as compared to your currency, or if you do not want to peg it against any other currency, then the safest asset is gold. You peg it against gold. Okay, so why did I say more stable currency? Because this fixing is actually done mostly by countries which have a much more volatile currency, right? That is mostly developing or underdeveloped countries. And why is the currency exchange rate system much more volatile? Because the overall economy is still developing and it is much more volatile. So the exports and imports and the basic demand and supply of the currency can suddenly rise and fall to much higher or lower levels within very short spans of time, because the economy is still developing. It's still not immune to all of those larger shocks which can suddenly come. Okay, So when that happens, a volatile currency is very, very bad for the economy, because suddenly if the currency goes extremely down, then the exports would become suddenly much more competitive. But at the same time, the imports would become so expensive that it would become very difficult for the people to sustain those imports. For example, if you need imports for very basic things like the food that you're eating, some specific food items, then those would become impossible for the poor people to buy. And at the same time, when this volatile currency suddenly goes really, really up, what will happen then is that the exports will become so unviable that all of your industries will start uh, getting that brunt of the high exchange rate which your currency has suddenly gotten into. Okay, so that is why a volatile currency exchange rate is something that no nation wants to be at. So to fix that, the central bank then tries to maintain the currency at a more stable level as compared to either some other currency or gold. And how is it done? It is done by the central bank of the nation through the use of a lot of forex reserves. Now, how do forex reserves come into play over here? See, any current currency's basic rate or exchange rate is nothing but a simple game of demand and supply coming at play. Okay, so this is the basic rule of economics: the demand and supply. So whenever a currency's supply becomes higher and demand falls, then what will happen is that the overall rate of the currency will start rising. Why? Because the overall rate of the currency will start falling, because there is much more people who are supplying the currency or who want to sell the currency, and much lesser demand of the currency in the market. Then lesser buyers, more sellers means that the buyers will actually get a better rate or a lower discounted rate. At the same time, when the demand starts rising badly in the economy and the supply starts falling, so now the opposite is happening. The demand is rising and the supply starts falling. At that time, the people who are demanding it are much higher, so they will be ready to pay much greater rates, or at a premium they'll be able to buy the currency, right? And at that moment, the currencies uh, rates will start going up. So that is exactly why the reserve bank or the central bank of the nation has to build a lot of reserves. Why? Because if the country's forex reserves are extremely high and the country has a lot of, let's say, dollars or any other foreign currency, then as soon as the demand starts falling, the country can quickly start selling dollars and buying its own currency in the forex reserves, right? And as soon as that starts happening, the demand fall will stop, and it will again start rising in the global market, because the central bank does it at a much higher level. Much beyond what a few traders can do. So when that is done, the falling value of the currency automatically starts rising. And at the same time, if the currency's value is rising to such high levels that you don't want it to be that high, because again the exports are starting to get affected over there, then what you do is you just the central bank just starts selling its own currency in the market, or dumping its own currency in the market, and starts buying the external currency, or let's say dollars. And when that starts happening, then the demand for rupee or the internal currency will fall, and the supply will rise to a much higher level, which will reduce its price in the market. And then again it will keep it pegged against whatever international currency or gold prices that you are trying to target to stay stable against them. Okay, so that is how the fixed exchange rate system works. But the most problematic thing over here is that you need a lot of forex reserves. It takes a lot of effort as well. A lot of work has to be put into it. And then most importantly, when you start doing this kind of a thing, then sometimes what happens is that, let's assume that uh, there there is a particular moment in the economy where you need to follow contractionary monetary policy, right? So a contractionary monetary policy basically means that let's say that the inflation was so high that you had to control the amount of supply of rupee in the market, and for that you started increasing your repo and reverse repo rates, so that the money in the hands of the people falls and the overall demand of goods starts falling and the inflation starts getting controlled, because now the people do not have enough money to buy their own food, right? So when that happens, you're trying to follow a contractionary policy, but then what if suddenly at the same moment your volatile currency starts rising badly? At that moment you have to sell off all of your rupee reserves, and you have to buy dollars from the international market in terms of your forex reserves, so that the currency still stays pegged against the global any stable currency that you're trying to target, or the gold, right? And when at one at on one side you're trying to control inflation by following a contractionary policy, which means that you want to control the supply of rupee in the market, but at the other side at the same time, if you have to sell off your rupee reserves in the market just to keep it stable, then you are at such a crossroad where you can either keep the currency stable or you can control inflation. You can't do both of these things together. It will become very difficult, right? So that kind of a tricky spot is actually where you can get put in at a lot of times if you are following a fixed exchange rate system. Okay, so these are the negative points of it. But the positive thing is that the volatility stays much more under control as compared to the regular floating or market-based systems, because over here the central bank is actually keeping it fixed in terms of any other currency or gold. All right, so there are the positives and the negatives of it, which I have put in front of you. Now, moving on to the second one. The second one over here is the floating or the market exchange rate system. So in the floating or market exchange rate system, it is determined by the forex market overall, as in the forex market of the world. And how does it determine? Same as I told you above, on the basis of pure demand and supply. In this floating or market exchange rate system, the central bank of the country, or the central bank or the Reserve Bank of India, let's say in India, the RBI, they do not come to play at all. Okay, they do not try to influence the exchange rate system by any means. They just keep it open and floating in the market, and let the market decide where it wants to take this exchange rate. Now the good part about it is that there is no effort of the RBI, no excess effort is required. RBI will or the central bank in general will remain much more free to do more important things which are required in the economy than just putting all its efforts into the maintenance of exchange rate. And then second, another more important thing over here is that the forex reserves, they do not have to be kept at extremely high values, right? The forex reserves can be kept at very low values, because we do not need to do sudden buying and selling of a lot of external currency and our own internal currency at the same time, because the market is the only person who is deciding the exchange rate system, right? So when the forex reserves are actually brought to much lower levels, the excess money that we save, that money can actually be put into a lot of infrastructure and a lot of welfare schemes, which will actually do what that money of the government is supposed to do, that is the welfare of the nation and the growth of the economy, right? And it will not be put into something as useless as just staying in a reserve and just being brought out when required and then again being brought in when not required. So staying in the reserves is not doing anything good for the economy as a whole. But now this money can actually be put into the infrastructure to grow the GDP, to grow the economy of the nation overall, and to put it on a long-term growth track. And at the same time, it can also be put into welfare schemes like, let's say, food for the poor people, health welfare schemes, or education, or drinking water, sanitation, so that the true welfare component of the nation can actually be focused upon. Alright, so these are the positive things about it. But again, the negative thing is that because it is directly determined by the market, so a market exchange rate system is again a thing that is much more volatile, and this volatility can at any moment come and haunt us by affecting the inflation and the overall, let's say, the imports and exports of the nation. Okay, so that is again a negative component of it. But mostly developed nations can go for floating or purely market based rates, because they have a much more stable economy and a much more stable uh, currency as well. So their currency exchange rates do not go through such huge volatility shocks as compared to the developing nations. So you can see that currencies like the US dollar, they are purely mostly market or floating exchange rate system based. Okay, so these ones, because they are from developed countries, they can afford to keep them market based. But a developing or a underdeveloped nation, it's very difficult for them to keep it market based. The volatility will be such high that the economy will be destroyed. So that is not an option for them. However, there's a third option which has come into play in recent times in a much better manner, and most of the global economies are actually following this one now. And this one, even India is following it now. Earlier we had a fixed exchange rate system, but now we started following this one. And the type that we are talking about over here, the third one, is actually the mixed exchange rate system. Now, mixed exchange rate system is actually a mixture of both fixed and floating exchange rates, and most global economies follow it. So basically what happens over here is that you keep the exchange rate system floating, in the sense that you do not interfere with smaller volatility shocks. So let me put the word small over here. Smaller volatility shocks, you do not intervene. But as soon as the volatility starts getting out of control, as in, let's say that the rupee was at 75 rupees per dollar yesterday, and today it became 74.7 rupees per dollar, you do not need to intervene in such small things, and you do not even need to put all of your energy into such small things. But if suddenly from 75 it goes to 69 in, let's say, a week, then there is a lot that is coming at play. Almost 10% has changed. And if that is the level of volatility that is coming into play, then at such high volatility levels, then the central bank or the reserve bank of that nation will come and try to manage or control the overall exchange rate system, right? So it's a kind of a mixture where small volatility you do not care about it. But when the volatility starts rising, or when the currency exchange rate system suddenly starts going haywire, that's when the central bank comes and says, hey, stop, I will do something about it now. Don't worry, I will take care of it, and our exports and imports won't get affected in such a manner that our entire economy starts going haywire. Okay. And the Reserve Bank of India, that is our own central bank, uses a managed floating exchange rate system. And this managed floating exchange rate is basically a mixed kind of an exchange rate system, because it is floating but it is managed at the same time. Okay, so the Reserve Bank manages it, but overall it is floating exchange rate system. And it is basically a floating / market exchange rate system where RBI intervenes to manage volatility. Okay, so small differences, they don't actually try to intervene, but when the market volatility starts rising, the RBI gets into intervene and manage this exchange rate system. Okay, so that is all about our currency exchange rate systems in the world, and you have to remember this one. Okay guys, so let's move ahead then. Errors and omissions. Okay, so these are the last part of the BOP, or the balance of payments of a nation. So what errors and omissions actually signify is that they balance the BOP, or the balance of payments account. Wait a minute. The BOP, or the balance of payments account of a nation, by taking care of any transaction that gets left out due to its invisibility or due to any difficulty to track it. Okay, so in the beginning I told you that if any kind of transaction somehow gets left out, let's say because of its invisibility, because it was so hard to track such invisible payments, in terms of they were maybe let's say services, some such a tricky gray area service that it was next to impossible to track it, or maybe because of some other error in tracking your transactions, if some of them actually got left out of the economy, they can actually be then made a part of the errors and omissions. Okay, and how do we do it? we consider each transaction with its proper sign, that is positive for exports and negative for imports, as I told you, and then the overall BOP should cancel out. What do you mean by cancel out? By that I mean that the current account balance, the capital account balance, and the forex reserves, all of these three, when you consider the overall change in them, so the change in the current account balance, the change in the capital account balance, and the changes in the forex reserves, when you add them up and then you add errors and omissions into them, the overall answer should be 0. Okay, so they should all cancel out each other. That is how BOP functions. Or in a much more simpler sense, you can just say that errors and omissions are equal to the total change in the current account balance, capital account balance, and the forex reserves of a nation. Okay, so that is how you calculate the errors and omissions. Okay guys, so let's move ahead then. The rupee convertibility. This is probably the last topic in this chapter, and what we are trying to understand over here is that how convertible is our currency, or the Indian national rupee, or the INR. Now, what is convertibility first of all? Initially we saw the exchange rate of currencies. So we saw that currencies can be exchanged at fixed rates, right? But then how convertible is a currency is another parameter that is very important. And convertibility is actually the ease of conversion of a domestic currency to any other currency like the US dollars. Okay, so for example, let's say you have 1,000 rupees, and then you go into the market and you say that I need to convert these 1,000 rupees into, let's say, US dollars. Now, can you easily just go into the market and convert these 1,000 rupees into US dollars? It might not be that as easy as it looks. I mean, where do you go? How do you get it converted? Do the banks or the financial institutions actually give you a free hand in getting all of your rupees converted into dollars? So all of that is what falls under the convertibility of rupee, or basically the ease of conversion of the domestic currency into a foreign currency, okay, into any other currency. That is called convertibility. Now, currency convertibility is basically of two types: the currency convertibility in capital account and current account. Again, all the transactions that fall under the current account, for them, if that money you try to convert into another currency, that becomes a current account convertibility. And for all the transactions that happen in the capital account, and then you take that money and try to convert its currency, that becomes capital account convertibility. Okay, so let's talk about the current account first. Rupee is fully convertible in current account since 1994. Okay, so all the transactions in the current account that happen, for them you can convert 100% of your rupees into your any other foreign currency that you want. And that this 100% current account convertibility was brought about in India in 1994. Okay, and later on this current account convertibility was actually governed by the FERA rules, or the Foreign Exchange Regulation Act. Okay, you should remember this name, Foreign Exchange Regulation Act. But then this FERA Act was actually replaced by a new act in 1999, and this new act was known as FEMA Act 1999. And FEMA is actually the Foreign Exchange Management Act. Okay, Foreign Exchange Regulation Act was converted into Foreign Exchange Management Act, not converted but actually replaced by the FEMA Act. And according to this act, there are very few restrictions, and the most important out of them is that under the liberalized remittance scheme, a maximum of 2.5 lakh US dollars can actually be converted by one person in 1 year into India. Okay, so a maximum of 2.5 lakh US dollars can be remitted per person in one financial year. Okay, so there are a few restrictions like that under the FEMA, but overall the rupee is fully convertible in the current account. However, when it comes to the capital account, the rupee is not fully convertible. It's a very interesting concept. Rupee is only partially convertible in the capital account. And how much is it convertible? It is convertible in the ratio of 40:60. Okay, so 40:60 is the convertibility of the rupee in capital account. And over here we have one more important concept that this question has actually been asked in a few exams. So the question is that which committee actually recommended the 100% capital account convertibility in India? So capital account convertibility was actually recommended by the Tarapur committee, which gave its report in the 1990s, I believe, around the year 94 or 5 itself. I'm not sure though. So you can check if you want, but that's again not important. In the 1990s, what is important is that the Tarapur committee gave its recommendations on the capital account convertibility. All right, guys. So that's all about the rupee convertibility. And now we come to the final topic. This is the BOP crisis. And I'm sorry, you must be thinking that the presentation is over, but it's taking a lot of time. But it's okay, guys. It's an important chapter, and it needed all of this time. So this is the last topic, and now we're going to discuss what a crisis of BOP is all about. So what happens is that, let's assume that your imports are much higher than your exports. Okay, so let's assume that imports are much higher than exports. And what will happen in this case is that you are spending much more money as compared to your earning, right? And your current account, because the imports and exports, they directly come under, be it visibles or invisibles, they directly come under the current account, right? So when your imports are much higher than the exports, your current account will start going into a lot of deficit, right? The current accounts deficit will start rising. And what is a current account deficit? We recently studied that current account deficit is nothing but the CAD that in general, CAD, or the current account deficit, that in general a lot of economic experts talk about, right? So when this deficit in the current account starts rising, our CAD starts rising. So when we have a very high CAD, and at the same time the foreign investments are also low. Now what does a low foreign investment indicate? Low foreign investments indicate that let's put it over here, that the capital account is also going into a deficit, or if not a deficit, then the capital accounts positive, or the surplus is also not very much, right? Low foreign investments means that the capital accounts, they are either in deficit, or even if they are in the surplus, that surplus is not sufficient to cover for the current account deficit, which is extremely high. Got it? So when we have high CAD and low foreign investment, then at that moment our forex reserves will start dwindling. Why? Because capital account plus current account plus forex reserves plus errors and omissions, all of these have to overall balance out each other and become zero, right? So if the capital reserves are not being able to suffice for the current account going into a lot of negative, then the forex reserves will have to actually cover for that. So if the current account is going into a lot of deficit, then all of that money will come from the forex reserves, which means the forex reserves will start falling. And once the forex reserves start falling, then we will actually have very less amount of money to cover our imports as the days start passing by, right? So let's say that every day we start losing 10 crores in terms of the imports that we need from the forex reserves. Then after 10 days time, 100 crores would be what the reduction in the forex reserves is, right? And then at one moment, because this is not a sustainable model, every day you're starting to remove more and more money out of the forex reserves. So this is of course not sustainable. At some point of time you will reach a moment where the forex reserves will actually almost get depleted, almost become zero, and then you will have no more money to cover for your imports in the current account, right? So once that happens and your forex reserves almost reach the value of zero, then you won't have any more money to cover for your imports, and ultimately your people will stop getting those imports which were very basically necessary. For example, if you were having imports which were very necessary for your industries, then those imports will stop coming in, and at that moment your industries will stop whatever production they were doing with those imports, right? Or if the imports were as basic as the food or any other, let's say rice, wheat, or any other food material which your country is not being able to produce, then your people will start going hungry. If it is clothes, then your people will start going without clothes, or whatever it is, that thing will stop getting imported into your country, and that is when the economy will become reach a point of disaster where there is no coming back, because now you don't have money to buy things and yet you need those things. So basically you don't have things and you are just starting to fall apart. Okay, so that is exactly what a BOP crisis looks like. Got it? It's a very simple kind of a thing. When the current account starts going into a lot of deficit and the capital account is not able to cover for that, then the forex reserves have to cover for that. But this is not a sustainable model. So ultimately, slowly your forex reserves start falling, and if this situation is not brought under control, then you will reach a point where these dwindling forex reserves will not be sufficient to cover for your overall imports. Okay, guys. So this is a BOP, or a balance of payments crisis, and this situation leads to a BOP crisis, which is also known as a currency crisis. And this crisis is where a nation is unable to pay for essential imports or services. Or okay, so first of all, the imports is what I talked about over here, right? But the interesting component, or the interesting part over here, is that the nation not just has to pay for its imports, the nation also has to, let me put it in a blue pen over here, the nation also has to pay for its debts, right? Debts, or let me put it in a much more simpler sense, loans and interest on those loans, right? And where does that loan and the interest paid for those loans come from? It comes from the government's pocket, right? And what is the government's pocket? If the reserves are falling, those are also from the government's pocket itself. So when the reserves start falling, the government doesn't have the other currency, as in, see, all the US dollars or all the foreign currencies that the country has, they are always put into the forex reserves of the country, right? So whenever the government wants to pay back its international loans with interest, or whatever the payments it has to make in the international sphere, it can't make in rupee, because rupee is not something that is accepted outside India, right? So what is accepted outside India? Only foreign currencies like US dollars, or if the country allows, then maybe euros or pounds, whatever they feel like. But US dollars is basically the currency that is accepted by everyone across the globe. But if the forex reserves fall to almost zero, then India will, even though we may have our rupees, but we will not have any dollars, right? So how will we pay them back? Now you might say that we'll go into the international market and sell our rupees and then buy dollars, right? That seems like a logical thing. But then the country can print as much rupees as it wants, and when a country is going through a BOP crisis, its currency will start falling to such bad levels that no one will actually be ready to even accept this currency in the global market, right? So if no one is accepting our rupees, then where will we go and who will we sell it to? No one will buy it. The only currency that they will be ready to buy is US dollars, and we don't have US dollars. So that is when we will start defaulting on the servicing of our external debts as well. So, and now we get into such a complex situation that we do not have any money to fund our imports, or to give back the loans that we have already given. So to fund our imports we need loans, but we are already not being able to pay back our previous loans. How will we get our new loans, right? So this is a point of total crisis for a country, and India had a similar kind of a BOP crisis in 1990-91, or the financial year 91 as you might call it. And the crisis was so bad that at one point India had forex reserves which could only support a maximum of 3 weeks of imports. So imagine, after 20 days we won't have any money to fund our imports or our external debt payments, and there was a lot of external debt at that moment. So we were at a big crisis moment at that point. And what ultimately helped us over there was that we ultimately borrowed 7 million US dollars from the World Bank and the IMF, or the International Monetary Fund, in 1991. Now, this might seem like a great moment for you, that yeah, the World Bank and the IMF came to India's rescue, and they are such great friends of ours, and they helped us at the moment when we were in such a big problem, and then we came out of it. But the answer to this question, the answer to this statement is that no, they are not, such big donors of money, or they're not just giving it out for free because they saw that India was in trouble and it needed money. No, no one does that in a capitalistic world. So when IMF and the World Bank gave us $7 billion in 1991, it was a huge amount in 1991. So when they gave us that amount, they actually gave it with a lot of conditions. So there were certain conditions that were put against those loans. So if you want these loans, you have to fulfill these conditions. Otherwise, we won't give you loans. And we had to bow down to those conditions because we had no other option. No one was giving us money. No one was buying our rupee, and no one was giving us dollars. And our imports had only 3 weeks to be is what we could cover in terms of our forex reserves, and beyond that we were finished, right? So we had to accept those bitter conditions, and even though that those might have gone against the basic, how our constitution makers saw our country to go in the direction which they wanted our country to go post independence, it was much against those values, but we had to accept it because our economy was not working out somehow, and we were in a crisis, and we had to get out of it, not just in the short run but also in the long run, and make our economy much more sustainable, right? So that is when we started moving from socialism towards more of a capitalistic economy. And what happened is that India had to liberalize its economy, remove trade restrictions, and move towards privatization. These were the basic conditions if we put them in a very, very crude sense. Okay, you do not need to remember each and every condition that was put by the World Bank and the IMF, but you need to understand the rough direction where they were trying to put India in. They were trying to put India in the direction of liberalizing the economy, removing trade restrictions, and moving towards privatization. And these reforms, which India then had to go through, they are popularly known as LPG. Okay, they are popularly known as LPG. And what does LPG stand for? Liberalization, privatization, and globalization. And these are, of course, chapters that you will study separately as the liberalization, privatization, and globalization in the ESI section itself. So I hope some of you might have gone through them, others might not have. But don't worry, these are separate chapters that will be covered separately. But over here with this slide, now you've understood why we had to go through the process of privatization, globalization, liberalization, and removing all of those trade barriers, letting other companies from across the globe come to India and start doing their business in India, and our own industries, especially those which were our MSMEs that we had kept shielded from the entire globe. We suddenly had to expose them to a big competition, and most of them even got destroyed. Why we had to do all of that? The reason for that was this BOP crisis which India went through. Okay, and this LPG reforms is also known as the New Economic Policy, or NEP, of 1991. Okay, guys. So NEP, or the New Economic Policy. So that's all for the chapter of BOP. I hope you've understood all of these things properly, and I hope that there's no doubt that is there in your head. If there is still any doubt, then please put it down in the discussion section below, and we'd love to solve all of your doubts, and we'd also love to hear from you about this chapter, how you found it. And if you guys have any other queries which are not pertaining to this chapter but some other thing regarding something that you want to get back to us on, then you can surely write an email to us on hi@litmode.in, and we would definitely reply as soon as possible for us. But for your chapter based queries, please put them in the discussion section below. You will get a much faster response in the discussion section because you will put it in the right ESI section, and you will put it under the right chapter. So we won't have to first verify that which subject are you talking about, and then which chapter are you talking about, and the concerned faculty would directly be able to get contacted for these discussions. So this is a much faster way. If you have any chapter based discussions, But any other queries that you have, just write to us at hi@lytmode.in, and we would definitely get back to you as soon as possible. Okay, guys. So I hope that you enjoyed studying this chapter. It's a very very interesting chapter, and once you understand this, I don't think that you will have to go through this video again and again. Just go through the PDF notes, and you will understand everything. Okay, guys. So thank you so much for watching this video, and please keep working hard. You have to crack the RBI exam in this attempt, and I hope that you will all crack it in this attempt itself, and I hope that you will all study hard and make us all proud, right? Okay, guys, then bye, take care, and keep leveraging your time and keep studying hard.